July 8th, 2024. I thought at the end of the day, this bounce was about the 9 low. You can see the bulls who bought below the bar 9 low were never let out back at their entry price. They could have scaled in, but we were never able to get back to here. In general, when you have a reasonable bull buy signal bar, there should be buyers below it. 60, most likely 60% chance, 70% chance, whatever, depending where your stop is. But those traders, there's an 80% chance if they buy below the 9 low and they buy more above, say, a bull bar 18, an 80% chance they'll be able to get out around break even. So when you saw bar 18, a reasonable reversal up, 3 pushes down, 7, 11, and 14, and wedge double bottom 18, there was an 80% chance that we got between here and here to about this price. And you can use that stat with pretty much any bull bar. Here and here. And I thought, even though that's at the 60 close, right? So that's another magnet as well. And the bar 60 low was another magnet that was going to be important. But so 80% chance if if you get a bull bar like this, that if you buy below and you scale in lower above a bull bar closing near its high, that you'll be able to get out at break even. 60% chance that we will get all the way back to the 9 low. And those traders who bought below the 9 low will be let out with a profit on their second entry and around break even on their first entry. So I thought 60% chance that we were going to get back to the 9 low at some point today after I saw those bulls get trapped on whatever bar 10, 11, 12, whenever you want to consider them trapped. After you see that, you got to be thinking 60% chance we're going to get back to the 9 low. And I thought even towards the end of the day, that was the target that we were trying to rally towards. We got some pretty aggressive bounces during these bars, but we were just never quite able to get there, which I thought was relatively surprising. It's important that this bar closed where it did as well, because you can see there was a fight at the end of the day about the open of the day. Trading range days, usually the open of the day is a magnet. I actually gotta add this into my magnet. My vacuum test. There we go. Test the open of the day. So yeah. So I don't know. I don't really got to show an example, but there are, on trading range days, the open of the day is a magnet towards the end of the day. And so the market will often vacuum up towards that magnet at some point. Additionally, what's important about the open of the day today is that bulls were looking for another follow through bar. And instead, they got a bear bar. So this is a spike. Bulls are hoping this is a pullback and we start a channel. Bears are hoping that bulls get disappointed somewhere up here and they sell out of their longs. And they're hoping this ends up being a failed breakout above this tight trading range, which I still think is probably a final flag. So they're hoping this is a failed breakout above this tight trading range and we're going to come back into this area. What's more likely? I don't know. I don't think this is going much higher. I think a pullback is likely. I think we're getting back to here, and I do think we're testing back into this range. So I don't know. We might go a little bit higher, but I do think we're going to pull back into here. I'd be surprised if tomorrow was a strong bull trend day. And after you get a strong bull trend day, so you know that Friday was a strong bull trend day, and after you get one of those, you know that there's a 75% chance that the following day will contain 2 hours of sideways to down trading starting by the end of the second hour. There's a 50% chance that you get some sort of decent follow through buying on the open. This probably qualifies, but this is the bare minimum basically for the bulls to qualify as follow through buying. It's really not that strong. So in general, 50% chance of follow through buying, 75% chance of 2 hours of sideways to down trading starting by the end of the second hour, which leaves only a 25% chance coming into the day of a bull trend from the open after the prior day was a bull trend from the open. So anyways, bar one, a bull bar, but a big tail on the top and a tail on the bottom. It's good for the bulls, but it's not quite as good as it could be. You'd like to see bar one close on its high if you're a bull. We do have an open gap with yesterday's high in the bar one low. That's pretty important for the bulls because usually if you're going to get a bull trend from the open, you'll get 2 open gaps early on. And this qualifies as 1 open gap. So bulls are hoping we don't get back to this high. However, we need signs of a strong bull trend early in the day in order for that to happen. Otherwise, traders will look at this as a gap within a trading range, meaning it's most likely to close. So whatever, 60, 70, maybe 70% chance that this gap closes if traders become convinced it's a trading range open. Bar 2, a bear bar, but a big tail on the bottom. This is a possible high of the day. Maybe only 30% chance that if you sell below 2, it's going to be the high of the day. I'd probably rather wait. Some traders will scale in more on bar 5 and 6 or 4 and 5 as we trade above the bar 2 high or above the bar 1 high. So is it theoretically reasonable to sell below 2 and just put a stop right here? Maybe, but it's just really not that good. A lot of the traders who are selling here, what they're doing is they're scaling in more here, and then they're using the sell off on bar 7 to exit their long, and you can see it got right back to their entry price. So those traders are using the sell off on bar 7 to exit their shorts. Bar 3, a reversal up. It's a high one for the bulls. So the bulls are hoping that bar 1 is the start of a new bull trend. Bar 2 is a pullback in their bull trend. And bar 3, bull bar closing near its high. High 1, first high 1 in their new bull trend. They want to see this continue to rally pretty quickly because, again, if traders get convinced this is a trading range open, it's more likely that we're going to end up touching yesterday's high. Bar 4, it's follow through for the bulls, but it's not what they wanted. You wanted a bull bar convincingly closing above the bar 1 high and breaking out above it. Instead, we found sellers up here, traders, bears, willing to scale in, who maybe sold above the 2 high during 4, and they're scaling in, knowing we're probably getting back here. So bar 4 is pretty disappointing for the bulls. Bar 5, you can look at as a second reversal down because we got a reversal. We went up on 4 and then got a reversal down, causing the tail. Up on 5 and then got another reversal down. So you can look at it as a second reversal down. Really what it is on a lower time frame is just a channel. I would imagine some sort of low 2 forming on, I don't know, I'll look at a 1 minute chart. So yeah, maybe, okay, so 2 legs up, 1 pullback, 2. And this is a second leg trap right here, these 2 bars. So this ends up being a second leg trap. But, either way, you can look at it as some sort of second reversal down, 2 legs up, kind of qualifies as the same. You're saying the same sort of thing. But regardless, it's not a very good short because it's a bull bar, but it's not really great to be long up here because it's probably going to be a trading range open. Because in general, 80% chance of a trading range open. And the bulls, 3 was their chance to prove that this is going to be a bull trend from the open. And instead, we got a big tail on 4 and a big tail on 5. So it's really not all that good. Low 2 short below 5, but a bull bar. So I would imagine there's going to be buyers below. You can see there is initially during 6. And so traders, they buy below 6, they scale in lower, and we get a bounce on 7, and they exit somewhere in here, which is what causes, they got a bounce during 6, and they ended up exiting in here, which is what caused 7. 5 was still a second reversal down, but obviously really not worth taking. It did end up being the high of the day, but I don't think it's really worth selling that and betting on that. I think I'd rather wait for a bear bar closing near its low. 7, a bear bar, but a big tail on the bottom. Yes, we broke out of the 6 low and it closed below the 6 low, which is good for the bears. We're probably going at least a little bit lower. To me, bar 7 is what confirms this is a trading range open. Lots of tails on 4 and 5 and 6, and still a big tail on bar 7, but it's a big enough bear bar to me to confirm that this is a trading range open. Additionally, the traders who sold here, they scaled in and they made money. So bears are scaling in and making money, which is more signs that this is probably a trading range. So if this is a trading range, what does that mean? Well, if it's a trading range, we're probably going to close this gap because this is yesterday's high and we have an open gap with the traders who sold above yesterday's high. They should be able to make money. So trading range open, now, with bar 7, most likely trading range open, and we're probably going here. Bar 8, a bear bar closing near its low. It's an IOI pattern. So we have an inside. So 6 is inside of 7 and 8 is inside of 7. Really what that means is it's a breakout mode pattern. So, increases the odds of some sort of breakout happening to the upside or the downside here. The bulls had a couple of chances to get a good breakout to the upside. Bar 3 was their main one, and bar 1 was even, you could argue if it had closed stronger, it's incredible, attempt at a breakout and, of essentially yesterday's high. They're not doing all that great with it. So to me, trading range open, we're probably going here, probably more likely the breakout goes to the downside, maybe, 10% more likely, maybe 60% chance if we get the breakout here, it's going to be a bear breakout instead of a bull breakout. Disappointing follow through on 9. So it's again, IOI pattern. Another way to look at that, by the way, would be the breakout is bar 7. So bears are saying we had a breakout on bar 7 below bar 6. We closed below bar 6. Good for the bears. And they think that this tail on 7 is just a breakout pullback. So, you could look at 8 as a breakout pullback sell. I think the IOI, breakout mode pattern sell is a bit of a better way to look at it. But either way, I think the traders who are selling below 8 think this is the high of the day. And maybe they have a stop up here. Probably have to take a piece off down here because, it's a trading range day, so it might be difficult to hold. But again, probably not unreasonable to sell. I didn't know that measured move was there, but it's not surprising that it is. It's a measured move of the opening range. but probably not unreasonable to sell below 8, put a partial profit taking order here, and take off the rest down here at the measured move of this opening range. And if you do that, you probably just walk away for a few hours, and you hear a ding on your computer, and then you come back and basically reset your OCO, and then walk away again. 9 outside up, not all that surprising because you had 4 straight bull bars from 3 through 6, so we're probably going to get a second leg sideways to up, probably buyers below, probably sellers not too far above, and then we get 10, a big bear bar closing near its low. Bulls are hoping it's a second leg trap, so 7, 8, first leg down, pull back 9, and second leg down on 10. But again, it's not really worth buying, down here, betting it's a second leg trap because we're probably still going to this high. So it's a bit difficult for the bulls right now. And sometimes what will happen is the bulls will just give up and you'll get a quick vacuum test of the high and then a bounce. But you can see the bears tried to get that on 11, but they still weren't able to close the gap, and 11 got bought back up. What do the bulls see? The bulls see a high 2. They look at bar 8 as the high 1. So they may be thinking this whole thing is a lower low double bottom and a big breakout pullback because 11 has such a big tail, but it didn't close the gap with this low. They're hoping that 12 is going to be a big bull bar closing near its high, trapping in the bears who are selling above 11. Because think about it, if you're still a bear and you're still convinced we're going here, why not sell above the bear bar and bet that we're going to get back to this high? And if you do sell above that bear bar, betting that we're going to get back to this high, which probably is a relatively logical thing to do because this looks like a trading range, so we should get here. And 12 is a big bull bar closing near its high. What are you going to think? You're going to think, maybe I'm trapped. Maybe this is going to remain an open gap, and this is going to be the start of a bull trend. So the bulls want 12 to be a big bull bar closing near its high, probably above the 9 low, showing that the bulls who bought the 9 low and scaled in lower, maybe at the low of the day, are not using the bounce to get out at the 9 low. So if 12 had been a bull bar closing, on its high, maybe somewhere up here, a lot of bulls would have bought that as a credible possible low of the day. At least that's what I think. What do the bears want? Sometimes, the bears on bar 12 will get an outside down bar and just vacuum straight down to yesterday's high because it's not a very good buy directly above 11. It is a second reversal up, but it's still a bear bar. So ultimately, 10 and 11 should get a second leg sideways to down. 12, again, ends up being neither of those things, and it ends up being a disappointing doji bar. So what does this mean? Well, it's still really tough, right? Because if you're a bear, you're sitting here thinking, why aren't we getting, a quicker test of yesterday's high? Why aren't we just going straight there? And if you're a bull, you're thinking, well, not really sure I want to buy until we get to yesterday's high or I get a strong bull bar. So the market, the odds of anything are really not all that excellent in here. It's probably still okay to be short on the sell below 10 or the sell below 8. And I think we are always in short, but I think if you're a bear, you're questioning a lot of things right now. 13, a bear bar, but a big tail on the top. Trigger below 12. We do get a close below the moving average, which is good for the bears. And again, we should get here, but I'm not sure how much further down we're going. These are essentially both doji bars, so there's probably going to be buyers, stepping in relatively soon. 14, another bear bar, but a big tail on the bottom. It's a possible wedge, bar 7, bar 11, bar 14. So 3 pushes down. What does that mean? It means we should get 2 legs sideways to up. We might try and get a bounce. Like I said, once we got down here, I started looking at the 9 low as a possible profit target. So a pretty reasonable place for the bulls to look for a rally. At this point in the day, I'm thinking, 60 to 70% chance that at some point today we end up getting some sort of bounce. This is not going to be, maybe 60 to 70, probably like 7% chance that this is not going to be a bear trend day and that we're going to end up getting some sort of rally later in the day. I thought it would come earlier than this, and this is not a very tradable rally. It's not all that great. This was a little more tradable, but you had to sit through something tough, and then you got the bounce at the end of the day. But regardless, I thought once we started to go sideways here, 60 to 70, probably closer to 70% chance that we end up getting some sort of bounce today. I was pretty confident, but you can't just trade just strictly based on that stat. You have to look at the price action in front of you. 16. An inside bar, so we have an II 15, 16. The bulls see a final flag for the bears, thinking that bull bar 16, and with all these dojis, bears really aren't going to want to sell below the bull bar on 16. There's more likely going to be buyers below 16 than there are sellers. You can see 17, we end up going essentially outside down and find buyers below bar 16 during bar 17. Again, we're probably going to get some sort of bounce pretty soon here. And then you get bar 18, a bull bar closing near its high. So we have the wedge 7, 11, 14. So we're getting a wedge double bottom with, or it's not really a wedge double bottom. I suppose the wedge double bottom would be more like if 1 was over here and then we got the wedge here and that'd be a double bottom. But either way, it's a double bottom failed, you could argue a failed breakout attempt of the wedge and a reversal up on 18. Regardless, the thing you need to know, whatever you want to call it, is it's a couple of attempts down by the bears and they're failing. So what does that mean? Well, to me, this looks like a leg in a trading range. Does this look like a bear trend to you or a leg in a trading range? Probably a leg in a trading range. Bear trend would have much stronger looking bear bars and not so many doji bars, and definitely not a bull bar closing near its high, and not this bull bar closing near its high, this bull bar closing near its high, and a really big bull bar here. So there's a lot of reasons to think that this is probably not a bear trend from the open. And with that logic, bar 18 is a good candidate for a possible low of the trading range. So it's a pretty strong buy above bar 18. If you buy above bar 18, the channel down is relatively tight. So you might need to stop a little bit, a little bit of a wider stop and, somewhere down here to allow for a reversal against you. You're probably not going to let it get hit, but sometimes, 19 will trade down and you just have, I like to use a wider stop in this kind of situation so that I can have a little bit more flexibility with whatever 19 does. And I'm not just instantly stopped out below 18 if we go below there. Because a lot of times when you get a bar like 18, there's probably going to actually be more buyers than sellers below bar 18. Bar 19, we got a good looking bounce for the bulls initially, but then a huge tail on the top, which is not great. 80% chance we're going to get to at least this midpoint. You could argue that midpoint as well, but we never got back to there. Even the close of bar 6, we didn't even get that until over here. But you could argue 80% chance that we get between the high of 18 and the low of bar 9, which we do on bar 19, and we end up getting a big tail. It's not all that surprising that we have a big tail on bar 19 because the channel down is relatively tight. So we might end up getting one more leg sideways down. But I still think we're probably going to find a way to rally towards the 9 low, and 60% chance we end up doing that. At least that's my thought. 20, another bull bar. So 3 consecutive bull bars. You could argue 20 is closing somewhat near its high. So 18, a good looking bull bar, and 20, a reasonably okay bull bar. But these are not huge, strong bars, which is really, again, relatively expected with how tight the channel down was. You're not expecting that we're going to get some immediate humongous rally. That would be pretty unusual. So you have to be expecting us to go a little more sideways rather than down. However, bar 20 is a high 1 for the bulls. So they're hoping high 1 bull trend. And we're going to end up, getting a bounce maybe back to the bar 9 low. And if you're thinking about it, we're on bar 20 and we have not broken out of the 18 bar range yet. The daily range isn't all that large. I think at this point, what is it, 15, if that? Not even 15. So it wasn't unreasonable to think the daily range was going to double. It didn't, but it wasn't unreasonable to think the daily range was going to double when the daily range is only 15. And, yesterday's range was, what was it? 40, and the prior days was a couple days have been, not the half day, but prior couple days have also been in the 30 to 40 range. So when your daily range is only 15 after the 18 bar range, it's not unreasonable to think that the daily range is going to double. Basically, going off of that, you can use logic to figure out that that there's a 90% chance that we're going to break out of the 18 bar range. And buying above bar 18 or the close of 19 or buying below 20, you can bet that we're going to end up breaking to the upside of the 18 bar range. And maybe if you're lucky and we start getting strong bull bars, maybe even a measured move up. I don't think the measured move up is very likely, but I thought you could buy above 18 with a 40% chance that we get up to this high. That was my opinion on buying above 18. Thought 60% chance we get here and 40% chance we get here. Excuse me. You can see we ended up getting buyers below bar 20 during bar 21. 18, 19, and 20 are strong enough for at least a second leg sideways to up. So that this is going to be a minor reversal down with 20 as the sell signal bar after 3 straight bull bars. We're going to get a second leg up. 22, a bit disappointing, but it's important that it did not close below 21. If it closes somewhere down here, that would be a lot worse for the bulls, but we're getting reversals up. You can see the tails on 20, 21, 22. I don't know how well this is going to illustrate, but what I'm trying to illustrate is this is 3 attempts down on 20, down on 21, down on 22. The bears had 3 chances to go down, so it's some sort of micro wedge. This is a 2-minute chart, not doing well. There's some time frame where what I'm saying, maybe you could argue 1, 2, 3. So 1, 2, 3, some sort of wedge in there. Again, the important thing to realize is that it's 3 attempts down by the Bears. So regardless of the shape, it's going to end up acting probably something like a wedge. What's the problem? The problem is that 22 is a bear bar, and a lot of bulls do not want to buy above a bear bar. And the Bears are hoping that any rally up from here is just a second leg up from 18, 19, and 20, which is what 23 ended up being said second leg, and then we started to go down. The Bulls are hoping that the second leg up gets larger and turns into its own breakout, but they want a bull bar closing probably above the bar 19 high. 23, a good looking bull bar. It closes above bar 22, but it's not a bull surprise. It could just be a second leg up. I still thought, odds were that we were going to go a little bit higher. However, you have to be aware that sometimes we're going to start to go sideways to down here. It still looks okay for the Bulls because we've gone sideways, but if we're going to rally, it's probably going to be, around right now. We probably cannot afford another bear bar closing near its low if you're a bull. So if you're a bull seeing close at 23, you got to be thinking the next bear bar closing near its low, I'm willing to get out, which is why a lot of traders were buying during 24, trying to keep it from closing near its low. You can see 24 tested around the bar 22 close, and bears bought back short. So inside bar high 1 for the bulls on 24. We're probably going at least, I don't even know if we're going much higher. Again, I thought 24 was rather disappointing. I wanted to see a pretty good looking bull bar here, or at least some sort of bull bar and not a bear doji bar. One of the reasons that experience is so important in the stock market is because you start to develop a sense of when a trend has basically one more chance to do the thing it needs to do to turn into a trend. Otherwise, it's going to go the other way. So on the close of 24, I did buy above 18, and I was still long on the close of 24. You can see some bulls chose to buy around a 50% pullback during 21, 22. But anyways, I did buy above 18. And I when I saw 24, I was a bit disappointed, but I basically said to myself, if 25 is a bear bar closing near its low, I wrote in my notes, occasionally 25 is going to be a bear bar closing a little bit below the 24 low. I think the mark that I put where I thought was like somewhere in here, maybe one tick below. I think it closed a little further than one tick below the 23 low. But usually, but this will happen sometimes. And the only reason I know that is because I've just watched this exact same thing happen a ton of times. And so, it's one of the reasons why, the biggest piece of trading is experience, is because you just eventually develop a sense for what the market might do and the possible options and the probability of those possible options happening. Because, if you're a newer trader and you buy above 18, you probably don't have any clue what might happen. You're probably just buying and you're going to say, all right, I guess we'll see. But an experienced trader buys above 18 and they kind of know what the possible outlooks, the outcomes can look like, whether if we trade below 18 on 19, get an outside down bar and it starts to bounce and then we get a second leg up, or if it does something like this and starts to rally, or if it does something like this and then turns to the downside. So again, that's why I think experience, again, ends up being the most important piece of trading, which is, frustrating to hear, obviously, but it's the truth because, you just learn to develop a sense for these sorts of things. So 25, a bear bar closing near its low, triggers the low 2 below 24, but bulls are very disappointed. This is a second reversal against them. They're going to get out. A good bear bar closing below the moving average. Bears will sell below 25. But what's the problem with selling below 25? Well, first off, the thing you have to realize is we're getting lower lows and lower highs, but it doesn't look like a really strong bear trend, which means what? It's probably some sort of bear channel. And it ended up being, you could argue that we had the trend line break and then a lower low major trend reversal. So we needed the higher low here, and then we got the bounce. That's a reasonable thing to argue. But we do just continuously get lower lows and lower highs throughout the majority of the day until bar 73. So bears at this point think it might be a bear channel day. And what do you want to do on bear channels? You want to sell second reversals down for the moving average. So you can sell the close and sell below 25 and look to make a couple of points. Problem is, that there's going to be buyers down here below bar 18. So bears selling here, they're not selling, most likely for a swing. They're probably selling trying to make 4 or 5 points. You can see they were able to make 4 points. Why 4 points instead of 5? Well, the daily range is smaller today. We're only at 15, 16 daily range versus these days we're like 40 daily range. So when that happens, sometimes traders will be a little more conservative and they'll scalp at 4 points. So the traders selling below 25 ended up scalping it with 4 points down here instead of 5. And that's why you can see there was a lot of short buying back at exactly 4 points. Again, 26, it's a possible wedge. Maybe 1/18/26 or 1/14/26, whatever you want to call it. But I think that if we were going to get a reversal up, I thought 18 was a pretty good candidate. unless 27 is a really impressive looking bar, I'm probably just going to leave it alone. And like you'd expect, we end up getting a relatively disappointing bar on 27, a tail on the top. Again, it's a possible wedge, but I think if we were going to rally, we probably would have already done it. We go outside up on 28, but a tail. So, not really worth doing anything. Tails on both sides. A lot of traders are just going to stay flat. 29, an inside bar. So we have another IOI, 27, 28, 29. But this is really not very good for anyone. It's hard to want to sell with the big tails on the bottom. It's hard to want to buy because you're getting bear bars and not bull bars. The doji on 30, you can see there are buyers below 29. So I'm not really expecting much from this. And again, it's important that we're not getting above the moving average on this rally attempt. And then you get 31, a bear bar closing near its low. You could argue this was a trending trading range day, but the breakout on, it wasn't very clear because the breakout 31, 32 wasn't very good. Didn't go very far. Usually if you're going to get a trending trading range day, this will be a more clear trading range. And then you'll get a breakout for 4 or 5 bars. And then you'll get another trading range down here that probably very slightly overlaps with the lows of this trading range. So it's okay to sell below 31, betting we get a breakout below this wedge, maybe 50-50 chance we get some sort of reasonable breakout to the downside, and you're able to make something. But the problem is you're selling in a potential trading range. But it's important that the bulls were not able to get the market above the moving average here. I thought that was really important. You get big follow through on 32, so good for the bears, but consecutive bear bars, possibly a trading range day, and we're around yesterday's close, and the measure moved down. So I'm not sure how much lower we're going to go. It's definitely okay to be short, and we're always in short, but it might be more of a trading range always in short. Again, you're betting on the breakout below the wedge and a measured move down. The bulls want a bear trap, and 33 is disappointing for the bears. I think you see 33. I think a lot of traders would look to exit above 33, which is why bears sold the close of it and got an inside bar on 34. So 34, an inside bar, a low one short for the bears. But again, it's not all that clear. I think bears need good follow through, and instead they get a disappointing bar on 35. Probably sellers above 34, scaling in higher. Above 30. Yeah. So disappointing follow through on 35. Probably sellers not too far above, buyers not too far below. You can see we got buyers below 35, and the bears who sold the close of 32, disappointed in the pullback, probably using 36 to exit. I don't know if we quite got to the 50% pullback. We did not during that, but that's a place where bears might have looked to sell. 36, disappointing follow through, an outside up bar, but a doji and a bear bar, so really not as good as it could be. 37, again, disappointing. Again, for me at this point, I'm still not going to be surprised if we get back to the bar 9 low. This, to me, I'm thinking 75% chance of some sort of reasonable bounce today. But, the bulls need to prove themselves. They need to get a couple closes above the moving average. 38, a reversal down, but a doji bar, not as good as it could be. And 39, a second reversal down at the moving average. Bulls might exit, bears might sell if we can get below it, but you can see we don't on bar 40. An IOI pattern bar 40, you might try to break out to the upside here. Bar 41, unable to close above the moving average. If I see bar 41, I am not buying. I need the bulls to prove to me that they are willing to get a close above the moving average. And you can see bar 42, a doji bar. And then bulls dump their longs and you get disappointment bar on bar 43. I thought bar 43 was okay to sell because it's another reversal down from the moving average. The bulls keep failing at the moving average ever since basically bar 25, that breakout below. Bulls haven't been able to get it above the moving average. They don't seem overly interested. But the problem with 43 is it was not able to close on its low, and we traded up first during 44. So had 43 closed on its low and we traded relatively quickly below it, I thought that would have increased the chances that we get the breakout to the downside. It's also, like I said, I'm still kind of expecting a reversal up from how this day has looked, but it's pretty undeniable that you're selling on the bear channel line here. So I don't think it's wrong to look to sell down here. It just didn't work out. 45, an inside bar, so it's another IOI pattern. It's reasonable to buy above 45, I think. You're betting on, a smaller trend line break, maybe like something like this and some sort of attempt at a major trend reversal in a smaller time frame. But I think it's okay to buy above 45, and you're taking a chance we just get a bounce. But you're not buying above 45 and putting a stop here. That doesn't make any sense. It's an inside bar. A lot of times we'll get failed breakouts below these IOIs before they go. So you're putting a stop down here, 33, if you're taking the buy. Disappointment 46. The problem is, again, bulls don't seem to want to be able to get above the moving average, but 45 is a pretty good bull close, and the bears probably would have sold off already if we were going to get some sort of sell-off. 47, a doji bar, but disappointment 46, not a good looking bull bar, instead a bear bar. So not sure if we're going to go a lot higher. I need a good looking bull bar. And then you get it on 48. 48 closing above the moving average. It closes reasonably far above the moving average. So we should get at least 4 or 5 closes above the moving average. Reasonable to buy above 48 and hold, looking to get to at least the most recent subclimax high, which I think is the 29 high. 49, follow through for the bulls. So we have consecutive bull bars, but there's a tail on 49, which is disappointing. Again, I think it's possible we just vacuum right up to the bar 9 low, but I'm not sure it's all that likely at this point. We might end up going a bit more sideways first because you have a disappointing tail, 49. 50, it's a climactic bar, so your risk is big, 48, 49, 50. If you're buying, you're not even making 5 points to get to the 9 low. Excuse me. So you need good probability. And instead, you get a reversal down 51. Bulls, they were hoping 48, 49 breakout above the wedge from 33, but it doesn't seem all that good with 51. Can you sell below 51? 51 is probably going to get a second leg sideways to down, but you also know 48, 49, 50 is going to get a second leg sideways to up. So yes, with a wider stop, it's probably okay. 52 consecutive bear bars, but again, I don't know how much lower we're going. We're probably going to get a bounce. I'm assuming around 50% of 48, 49, and 50 around here, right? So we're probably going to get a bit of a bounce. So it's a pretty small scalp if you're selling it. Reversal up 53. If you're buying, you're using a wide stop, probably below 46, and you're buying more below 53. So consecutive bull bars 54, yeah, but I don't know how much higher we're going. Without a pullback, and then you get an outside down bar 55, which qualifies as the second leg down from 51 and 52, an inside bar 56, so 54, 55, 56, another IOI pattern, a breakout mode pattern. So I'm looking to trade a breakout here. 57, another inside bar, so it's an IOII. Really, again, breakout mode is what's important. Bulls see a high 2 with 53. 58, a bull bar closing near its high. I think 58 is a credible buy. Looking to get back to the 9 low. You have good risk reward, which meaning the probability is probably not as good as you want it to be. However, it's a trading range day, so it might be a little bit higher than normal, but it is towards the middle of the trading range, so that's a bit of a problem. But I don't think that it's wrong to buy above 58. Follow through 59. The problem with 59 is you got 58, one leg, pull back 59, and this is possibly a second leg up 59. But again, I still think it's okay to be long. The problem is sometimes when bulls see a bar like 60, if you're buying above 59, they wanted to see 60 breakout above the bar 54 high, breakout and maybe close above the bar 51 high. It confirmed that we're going to get a rally to the 9 low. Instead, you get a kind of disappointing bar on 60. So a lot of bulls just exit their longs and they sell out at the market, and that causes 61. 62, again, more disappointment. It could be a wedge. 53, 56, and 62, but it's probably better to just wait. And then you can see bulls give up. That causes 63. We trade to a new low of the day and get a huge reversal up on 64. It's a wedge, 133, 64. So a big wedge. You're expecting, when you have a pattern that's 60 bars, you're probably expecting, at least a correction of 20 to 30 bars. So really good buy above 64. Again, you're probably trying to get back to the 9 low. It's a bit ambitious, but you should definitely, I thought like 70% chance we get back to the bar 60 low, but you don't know what path we're going to take to get there. Follow through on 65 for the bulls, so consecutive bull bars, 64, 65, probably going at least a little bit higher. 66, a tail, so a bit disappointing. We might vacuum straight up to the 60 low, I'm not sure. And then 67, a reversal down from the moving average. Pretty disappointing. Bears want a lower high from 61, 62, 63, which is reasonable because it's strong enough for a possible lower high. But again, you could argue higher low or lower low major trend reversal for the bulls, or a wedge, one, like I said, trend line break, lower low. So trend line break, lower low major trend reversal, or a wedge, 133, 64. Sorry, when I make these videos, sometimes my voice gets dry. 1 second. But anyways, should be a lower high here, but this is probably going to get a second leg up as well. Buyers below 67 during 68 and an outside bar on 69. Probably trying to get a second leg up from 64 through 66. But again, bulls are not doing their job. This needs to move and pretty quickly. And I think 70 is pretty disappointing. At this point, if you're a bull, a lot of them will start to exit at break even or look for a bear bar closing near its low to exit. bears want this to be a bear channel and get below the 64 low, but I thought 64 is a pretty credible reversal, 60% chance of a pretty profitable trade or reasonably profitable trade. So I thought the move down from 67 to 73 was a bull flag. So not really worth selling below 71. You can see 72 a bear bar. Bulls might exit below 72, and then you get 73 a bear bar closing near its low. I think bulls know most bulls are going to get out below here because this is not doing what they wanted, and they'll just take the small loss. And so bulls buy the close, causing 74. Get disappointment here, but again, they buy the close of this bar, probably stop not too far below here, maybe here. Then you get a huge bounce, 75. You know we're probably going here at this point. I think 70%, you see 75, I think 70, maybe even 80% chance for getting to the bar 60 low. So as 76 is pulling back, traders are buying it, and we end up getting a rally, 77, and we get to that point. And if you were watching 78, the first 30 seconds or so of 78, the market just kind of freaked out and bounced really hard. And it was trying to, I think, get to here. But then the following few minutes, it failed. And basically with 20 seconds left in the bar, it was down here. And then it just bounced again because bulls were going to try again to get to the 9 low. Again, I was kind of surprised we didn't get there. But tomorrow, if we do, there should be sellers. For stop orders today, maybe bar 3, but difficult. 8, yeah. For a high of the day, 10, yeah. Possible high of the day, 18 makes sense. 25 makes sense. 31. I think there was quite a few reasonable entries, but most of them didn't go very far. And that's how trading range days are. You maybe sell 43. I don't know. It probably won't be marked, but on like Al's thing. But I thought there was something to it because bulls just couldn't get closes above the moving average. But maybe the tail on 43 made it worse. 45 makes sense. 48, yep. Maybe 51. I don't know. I thought 58 and 59 were fine. Didn't end up working out. 64 is a very good looking reversal. And you could probably buy above 77 if you want to be quick to make decisions, get about getting up a 9 low. The daily chart. So a disappointing bar for the bulls. The question becomes, will the bulls sell out of their longs and will turn this into a trading range, or will they look to buy even more? The weekly chart just starting, but outside up. When you see this kind of pattern, it doesn't usually get a big bull bar. It's follow through. We'll see what happens, but it's just not very normal for that to happen. So I'm not so sure we're gonna, and I don't want to talk about the monthly chart just yet. So yeah, that's the